The steep global sell-off continues, so how should investors handle it? European shares have plummeted to a 16-month low, while the S&P 500 looks poised to confirm a bear market when it opens later, after President Trump showed no sign of backing away from steep tariffs announced last week. Well, Damien Hill is a UK corporate bond portfolio manager at BNY. Damien, at one point this morning there wasn't a single stock in the FTSE 100 in positive territory. How do investors deal with this?
Absolutely. Well, thank you for that introduction. Yes, it's a challenging time, obviously, and there's been an indiscriminate sell-off, whether you looked at equities, bonds, and a raft of other asset classes. So what you've got to do is keep your head screwed on and look through the noise to see if there's anything that's been thrown out and treated indiscriminately poorly. So really, in an ideal world, you'd have been set up ready for this. Clearly, it was an announcement that took a lot of people by surprise. Clearly, he's been campaigning on the tariff policies for a while to try and reset US manufacturing, but definitely the extent and scope has been much larger. So clearly, there's been a lot of de-risking taking place, and as we speak, you'll see markets down 5% or so. So it's keeping a level head. Hopefully, you've been positioned appropriately to start with, but if not, it's really not panicking and having any knee-jerk sales and throwing out the baby with the bathwater, so to speak, and looking for opportunities as we go.
The US Treasury Secretary Scott Bessent said at the weekend that more than 50 countries are trying to strike a deal to get these tariffs lifted, including, of course, Britain. Should the market be trying to price in the possible shape of such a deal?
I think it's very early days to start pricing in relatives like that. The line we've heard from the Trump administration at the weekend is he's looking at tariffs in quite a new way in terms of trying to reset trade balances and seeing that as the kind of unfair nature of how the US is being treated, which flies in the face of quite a lot of economic theory. So I don't think we can second guess any kind of resolution to this in particular speed. So I think, whilst you can look at these relatives and hopefully there's some glimmer of hope as the negotiations unfold, I think it's too early to say that there's light at the end of the tunnel at the minute.
Are there UK stocks in particular that you think one should really be moving away from here? Sectors, for example, particularly exposed to trade with the US?
Sure. So in terms of when we put it in a corporate bond lens, because equities is not my area of expertise. What we've been trying to do is tilt the portfolio more to domestically focused non-cyclical sectors. So whether that's in the UK or wherever they might be in Europe or even the US. So in sectors like utilities, transportation infrastructure, telecommunications, and other sectors which are more kind of idiosyncratic to the UK, things like housing associations, etc., which are big bond issuers in the UK market. Whereas, we've been lightly exposed to more cyclically exposed, cumulative discretionary sectors and stocks. So things like autos, capital goods, but also sectors that you might think, maybe non-cyclical in other environments, but could be impacted by tariffs. So things like pharmaceuticals, food and beverage, and other kind of consumer goods focused sectors. So it's really tilting the portfolio in that way defensively. Financials is an interesting area because they're coming from a position of relative strength in terms of balance sheets. But if you do get more of a recessionary impulse coming through, which a lot of commentators are moving to say more like 50-50 in terms of a US recession at this point, then clearly they can come under pressure as well.
So where would you be moving some of that money, you think, then to domestically focused corporate bonds?
Yeah, to be honest, at the minute, the sector kind of dispersion between those non-cyclical kind of infrastructure exposed sectors, as I said, like telecoms and utilities, have been underperforming in line with the market. And actually the differentiation between some of those more tariff exposed sectors has not been big enough in our view. So we still think there's scope to do that. Clearly, trading costs are widening, so hence why you would probably want to have been set up like this to start with. But definitely, there's still a sense if you can get the switches done to switch between sectors that are more exposed to the tariffs to those more defensive style sectors, still probably has some value because the extent of the sell-off between the two has not been large enough in our view.
That was Damien Hill of BNY. Don't forget, you can watch more videos on Reuters.com.